Welcome on board Varun Lohchab and figure out what he's making of the market texture right now. Varun, hi, afternoon. Good to have you on the show. You think the need of the hour is some consolidation for the market to catch up some breath? And what triggers would you say is keeping the markets at higher levels, you think?
Yeah, hi, good afternoon. So you're absolutely right. We believe it's time for some consolidation in the market, which will be quite healthy because valuations have been running slightly ahead. I think what has been the positive is that earnings season has again been fairly good. There were around minor upgrades of around 1% to our estimates for both FY24 and 25. So this was another quarter of 20% plus earning growth on a YOY basis. However, we believe this will also fade away as we get into FY25 because the benefit of lower input cost is largely coming into the base after 1 or 2 quarters. So we have probably one more quarter left, which is Q4, when you will see strong margin expansion on a YOY basis. And then FY25 earning growth for our coverage universe is around 9%. And most of the sectors have hit sort of their steady state or above normalized level of profitability in FY24 itself. So I think some consolidation in earnings will also happen, which will probably keep markets in check, and markets should remain range bound in our view at an index level.
Okay, point taken. So that's a view on the index and how earnings are supporting that. But Varun, what are those fresh ideas that you have or your team has generated of late? Any fresh buy ideas?
So, see, overall, obviously, it's getting more and more difficult to find undervalued or undiscovered stocks because, as I said, there is no sort of obvious picks left in the market. We were bullish on energy space and OMCs and power and real estate. Most of them have played out last year. I think incrementally, when I look at FY25 and where earnings are probably in our coverage universe, where we are expecting a pickup in earning growth vis-a-vis FY24. One is obviously IT, but stocks have already run up in anticipation of that. So maybe few select stocks could be bought out there, but at an aggregate level, not much. Metals is where, especially steel, is where we see there is possibility of some upside in FY25 if China demand does not fall, further from these levels. And if there is any minor pickup, we believe some of the steel stocks could potentially offer some upside into next year. But barring that, frankly, we are largely continuing with the earlier themes, which was, industrials, power, real estate. Though we are taking some money off out there, we have cut our bets out there. We've increased our cash levels a little bit in our model portfolio. And it's going to be more selective and more bottom up. So not too many ideas, frankly, at this point of time.
Struggling to think where is it that you're finding those bottom-up ideas to begin with. But maybe private banking could be one space, right, Varun? Because that's starkly underperformed as opposed to what some of the PSU peers have done.
Yeah, so private banks, we are fairly well positioned already in our model portfolio. We have ICICI Access among the top bets out there. And then we have SBI and Federal among the other banking names. I think banking is going to be range bound in our view. Earnings next year will be in low to mid teens. And valuations, you are right, there is no froth out there, fortunately. So that protects you from the downside. But I think the upside also gets capped because, your credit cost and NIM are not going to get any better into FY25 compared to 24. So earnings will see a bit of deceleration even out there. And therefore, the absolute upside may not be a lot even in private banks, but it's a good space to be in given the fact that, our overall expectation from index also is not very high now. So yeah, private banks, we continue to be well positioned in our model.
Point taken, but since you're not expecting a big gain out of the frontline index, I'm guessing a bit of a change will be there on account of the sector churn, etc. Do you believe the likes of autos, real estate have peaked out and one should start booking profits and probably start putting money into FMCG or even IT and other sectors of the world which have been on the back foot?
Yeah, so I would not say that one should completely reverse out there. So as I said, what we have done is we have taken some money off autos. We have now gone underweight after almost 2 years of equal weight or overweight stance. So autos, I believe, is slightly overheated even out there. There will be a deceleration in earning growth in FY25. The benefit of lower input cost is already there in the P&L now. Real estate, yeah, I think near term they are looking probably a bit stretched, while residential upcycle will continue over next 2 to 3 years as well, which has been our call on industrials also, that the private and the government capex will continue to be robust. But I think all these spaces need a bit of consolidation into FY25. So therefore, we have been taking some money off from these places. Consumer staples and discretionary, frankly, we have still not, increased our or reduced our underweight. We are still negative. IT, yes, we have cut our underweight and it's more like a neutral now. So yeah, we are getting into some of the sectors which have not performed as well in FY24 as a rotation theme into FY25, but not across the board. So, metals, as I said, we have increased our weight from underweight to neutral. We believe cement and building materials could also do a tad better in FY25. So there will be some rotation, from some of these overheated sectors into the sectors which have not done as well in FY24.
Okay, that's the take coming in on some of the sectors over there. But in the meantime, Varun, wanted to understand what your view on consumption is at large. And let's pick up on the FMCG side of things, because the pressure is clearly to the rural exposure plays. You think that's also a bottom-up story that could be looked at? Or do you think, the green shoots will take some time to actually come up?
Yeah, so I think it's again a bottom-up story. Certain companies like Tata Consumer and all are still growing well, or say Nestle, which are less exposed to rural. So you have to look at each company's portfolio and see what actions they are doing in terms of new innovation, launches, distribution expansion. So a lot of things go into determining the growth rate. But at an aggregate level, rural demand still continues to be fairly muted. We believe, while it's not seeing incremental worsening for sure, there is modest improvement, and we believe that will continue, as the inflation level cools off and you will see better volumes coming through. But still, value growth will remain in, mid single digit kind of a levels, at least in the first half of FY25. So therefore, we believe there is no basket case of going overly bullish on consumer staples and FMCG, because there is not going to be any V-shaped recovery in rural in our view. But it's improving at the margin in terms of demand scenario. So we believe that should continue, but it's a very gradual sort of improvement rather than a very V-shaped improvement.
Okay, not expecting a V-shaped recovery in the rural consumption. Thanks, Varun, for making time and speaking with us. But